There is a ghost that haunts every investor, from the novice staring at their first stock chart to the seasoned professional managing billions in private equity. It is the ghost of past mistakes. For most, this ghost is a source of shame, a specter to be ignored, locked away in the darkest corner of the mind. We celebrate our victories, we toast our 10-baggers, and we tell stories of our foresight. But our failures? We bury them. We rationalize them. We whisper that it was bad luck, a market crash, a tweet from a mercurial CEO, anything but our own flawed judgment. This single, universal human tendency is the greatest destroyer of wealth in the financial world. It is the ego's defense mechanism, and it is a prison that guarantees we repeat the same errors, bleed from the same wounds, and ultimately fall short of the financial freedom we seek. But there is one man who, for over 70 years, has not only faced this ghost, but invited it to the dinner table. He has interrogated it, learned its secrets, and broadcast its lessons to the entire world. That man is Warren Buffett, and his radical approach to his own fallibility is perhaps the single most important and least copied element of his genius. He understands a fundamental truth that eludes 99% of market participants. Your mistakes are not your shame, they are your syllabus. Your errors are not liabilities, they are assets. Each one, if properly dissected, is a piece of gold, a priceless lesson in decision-making that you have paid the market tuition to learn. To ignore the lesson is to set the tuition money on fire. This is not a story about picking the right stocks, it is a story about building the right mind. It is a deconstruction of Buffett's most powerful tool, the rigorous, ego-crushing, and wealth-creating discipline of the investment post-mortem. We are about to embark on a journey into the heart of investor psychology, to understand why our brains are wired to fail, and how we can systematically rewire them for success. We will learn that the path to becoming a better investor is not paved with brilliant insights, but with the honest, unflinching analysis of our own blunders. This is the final promise of value investing, that within your worst decisions lies the blueprint for your best future. The first and most formidable wall we must dismantle is the one built by our own ego. It is a fortress constructed from pride, defensiveness, and a deep primal need to be right. To admit a mistake, especially a financial one, feels less like a simple acknowledgement of fact and more like a fundamental indictment of our intelligence, our foresight, and our very worth. This psychological prison prevents learning, locking us into a cycle of repeated error. The key to escaping is to understand the architecture of the prison itself, and no story illustrates the costly rent of living inside it better than the tale of the very company that made Warren Buffett a household name, Berkshire Hathaway. It is a story not of triumph, but of a monumental mistake born from a moment of pure, unadulterated ego. The foundational anecdote begins in the early 1960s. Warren Buffett, then a young, confident, and increasingly successful manager of the Buffett partnerships, was a practitioner of what he would later call cigar butt investing. He looked for wretched, unloved businesses trading for less than their liquidation value. He could buy them, take a final, free puff from the cigar butt, and walk away with a small, easy profit. In this hunt for cigar butts, he stumbled upon Berkshire Hathaway, a failing textile manufacturer in New Bedford, Massachusetts. The American textile industry was in a death spiral. Mills were closing left and right as production moved to cheaper locations overseas. Berkshire Hathaway was bleeding cash, a relic of a bygone era. But its stock was cheap. Dirt cheap. It was trading below its working capital, meaning Buffett could theoretically buy the entire company, sell off its assets, and make a risk-free profit. He began buying the stock in 1962. His plan was simple. As the company continued to liquidate its mills, it would periodically offer to buy back its own shares at a price slightly higher than his purchase price. He would tender his shares, pocket the difference, and move on. The man running Berkshire at the time was Seabury Stanton. Buffett and Stanton had a sort of gentleman's agreement. Stanton would continue to shrink the business, and when he was ready to do another tender offer for the shares, he would let Buffett know the price. In 1_9_6_4, Stanton told Buffett that the next tender would be at $11.50 per share. Buffett agreed. But when the official tender offer arrived in the mail, the price was not 11.5, it was 11 3/8. Stanton had tried to chisel him out of 1/8 of a point per share. A minuscule amount. An insignificant sum for a man like Buffett. But it wasn't about the money. It was about the principle. It was about the slight. Warren Buffett, the brilliant young man from Omaha, felt he had been cheated. And in that moment, his rational, calculating mind was hijacked by his ego. He was angry. Instead of doing the smart thing, tendering his shares, taking the slightly smaller profit, and moving on to the next investment, he did the opposite. Out of pure spite, he started buying more Berkshire Hathaway stock. He bought it aggressively on the open market. He took control of the company, and his first official act was to fire Seabury Stanton. He had won. He had exacted his revenge. And in doing so, he had shackled himself to a corpse. He was now the proud owner of a dying textile business in a dying industry. For the next 20 years, he would wrestle with this mistake. He poured good money after bad, trying to keep the textile operations afloat. He faced brutal competition, labor disputes, and relentless economic headwinds. He described it as trying to bail out a leaky boat, where his energy was better spent finding a new boat. The capital he invested to buy new equipment for the mills earned pathetic returns. The management team he inherited was honest and hardworking, but they were playing a game that was impossible to win. The business was a black hole for capital. It was only years later, after he began using Berkshire Hathaway as a holding company to buy wonderful businesses like See's Candies and the Washington Post, that his fortune truly began to compound. The textile operations were finally, mercifully, shut down in 1985. Buffett later calculated the total cost of this single, ego-driven decision. He estimated that if the money he had sunk into fixing the unfixable textile business had instead been invested in one of his better ideas, it would have compounded into an additional $200 billion. $200 billion. That is the price of ego. That is the cost of letting a minor slight override a rational business decision. It was a mistake born not of faulty analysis, but of a bruised ego demanding satisfaction, a psychological flaw that trapped a genius in a terrible business for 2 decades. The force that held Buffett captive in that New England textile mill is one of the most powerful and insidious in all of human psychology. It's a cognitive bias known as commitment and consistency bias. On a cerebral level, our brains are wired to value consistency. In an uncertain world, consistency is a shortcut for stability and rationality. When we make a decision, when we commit to a course of action, whether it's buying a stock, choosing a career, or firing a manager out of spite, we feel an enormous internal pressure to stick with that decision. To do otherwise would be to admit we were wrong, which our brain interprets as a threat to our self-concept. The story we tell ourselves about who we are, I am a smart investor, I am a decisive leader, is challenged. To protect this story, we engage in all sorts of mental gymnastics. This is where a second bias, confirmation bias, comes into play. After buying Berkshire, Buffett likely began subconsciously looking for evidence that the textile business could be turned around. He would have given more weight to a small operational improvement than to the overwhelming evidence of the industry's secular decline. He was looking for proof that his initial emotional decision was, in fact, a brilliant one in disguise. This process is deeply rooted in our neurobiology. When we are confronted with evidence that we made a mistake, it activates the same regions of the brain associated with physical pain and disgust. The brain's response is to reduce this cognitive dissonance, this uncomfortable feeling of holding two contradictory beliefs. I am smart, and I made a dumb decision. The easiest way to resolve this dissonance is not to change the decision but to change our perception of it. We rationalize. We tell ourselves, the industry will turn around, or I just need to be more patient. Furthermore, the endowment effect begins to warp our judgment. This is the tendency to overvalue something simply because we own it. Before he took control, Berkshire Hathaway was just a name on a stock ticker, a cigar butt. After he owned it, it became his Dole's company. It was part of his identity. Selling it at a loss would feel like amputating a piece of himself. These biases, commitment, confirmation, and endowment, form the iron bars of the ego's prison. They work together to make an objective reassessment of a failing investment nearly impossible. We become defenders of our past decisions rather than architects of our future returns. Breaking free requires not just financial acumen, but a conscious, deliberate effort to override our most basic mental programming. It requires building a system of thought that forces us to confront the possibility that our past self, the one who made the initial decision, was wrong. So how do we dismantle this prison, brick by brick? We need an applied mental model, a blueprint for thinking that acts as a cognitive crowbar. The most effective tool for this is a concept Charlie Munger championed: inversion. Instead of asking, how can I prove that my investment thesis is still right, we must invert the question and ask, what new information would definitively prove that I am wrong? This is not a natural way to think. It requires humility and intellectual honesty. It is an active rebellion against the confirmation bias that grips our minds. The blueprint for applying this mental model is a three-step process designed for rigorous self-interrogation, a key part of any sophisticated executive decision-making framework. First, you must create kill criteria before you ever make the investment. Before you click the buy button, you must take out a piece of paper or open a document and write down the specific conditions under which you will automatically sell the investment, no questions asked. These are not vague feelings, they are concrete, measurable events. For example, I am buying this retail company because I believe their new e-commerce strategy will grow revenues by 15% annually. If, after 2 years, revenue growth is below 5% for 4 consecutive quarters, I will sell the stock. Or, I am buying this cyclical company near the bottom of its cycle. If the key commodity price it depends on does not recover to X level within 18 months, my thesis is broken, and I will sell. By setting these rules when you are calm, rational, and not yet subject to the endowment effect, you are creating a contract with your future self. You are pre-committing to a rational action, protecting yourself from the emotional turmoil of a falling stock price. Second, schedule regular devil's advocate sessions. For your most significant holdings, you must proactively and regularly seek out disconfirming evidence. This means reading the arguments of the most intelligent bears on the stock. It means actively searching for articles titled, "The Bear Case for Company X." It might mean talking to a trusted friend or advisor and giving them one instruction: your only job is to tell me every reason why I am wrong about this investment. Do not spare my feelings. This practice forces you to step outside your own echo chamber. If you cannot formulate a strong, logical rebuttal to the bear case, you may be blinded by your own biases. This is a core discipline in high-level risk management. Third, when an investment has gone against you and you feel the emotional pull to hold on, apply the 5 whys technique, a method born from Toyota's manufacturing process. Start with the problem. I am down 40% on this stock, but I don't want to sell. Then ask why. Why don't I want to sell? Because I still believe it can come back. Why do I believe it can come back? Because the CEO is very charismatic and presented a great turnaround plan. Why do I believe the plan will work? Well, I haven't seen much concrete evidence yet, but I feel like it should. Why do I feel it should work? Because selling now would mean admitting I made a huge mistake and lost a lot of money, and I don't want to face that. By drilling down, you often uncover the true reason for your inaction. Not a rational analysis of the business, but a raw, emotional fear of admitting failure. This is the moment of truth. This is where you realize you are in the ego's prison. And that realization is the first step toward escape. To truly appreciate the power of this disciplined, inverted approach, we must examine its opposite. We must walk the path of the 99%, the well-trodden road of financial self-destruction paved with rationalizations and hope. This is the path of the average investor trapped in the ego's prison, a story that plays out in millions of brokerage accounts every single day. Let's call our investor John. John hears about a hot technology company, Future Corp, on the news. Everyone is talking about it. The stock has been on a tear. Fueled by a fear of missing out, he does some cursory research, which mostly consists of reading a few glowing articles that confirm his desire to buy, and invests a significant portion of his savings. Initially, the stock goes up. John feels like a genius. He checks his account multiple times a day, his mood rising and falling with the ticker. He has conflated a bull market with brains. Then, the market turns. Future Corp misses its earnings estimates. The stock drops 20%. The first stage of denial kicks in. John tells himself, "It's just a paper loss. It doesn't count until I sell. Great companies go through pullbacks." He is now anchored to his initial purchase price, and his ego will not allow him to realize a loss. He starts seeking out only positive news, diving into fan forums and ignoring the growing chorus of skeptical analysts. This is pure confirmation bias in action. The stock continues to fall, now down 40%. The pain is immense. His friends and family ask about his hot stock, and he changes the subject, the shame building. Now the most dangerous rationalization of all emerges. I should double down and lower my average cost. This is the siren song of the losing investor. It feels like a proactive, strategic move, but it is often an emotional act of desperation, a way to chase the original decision and prove it was right. He invests more money not because the company's prospects have improved. In fact, they have deteriorated, but because his ego cannot stomach the alternative. He is now committed more than ever, shackled to the anchor of his initial decision. Finally, after months of agonizing decline, with the stock down 80%, a wave of capitulation washes over the market. All hope is lost. The news is relentlessly negative. The pain becomes unbearable. John, exhausted and demoralized, sells everything at the absolute bottom, locking in a catastrophic loss. He swears off investing, declaring that the system is rigged. He never performs a post-mortem. He never asks, "What was my original thesis? Where did my analysis go wrong? Was I just gambling?" Instead, he blames the market, the CEO, the Fed, anyone but himself. The ego remains intact, but the lesson is lost. He has paid a massive tuition to the market and learned nothing. And because he hasn't updated his mental software, he is doomed to repeat this exact cycle the next time a hot story catches his eye, forever trapped on the path of the 99%. The financial consequences of this ego-driven behavior are not just theoretical, they manifest directly and brutally on an investor's balance sheet. The most significant cost is the ego tax, a recurring levy on your wealth that compounds silently and devastatingly over time. Let's quantify it using Buffett's own colossal error with the Berkshire textile mill. He stated that the decision, born of anger, ultimately cost him around $200 billion in opportunity cost. What does that mean in practical terms? Every dollar that he poured into that dying textile business, to buy new looms, to cover operating losses, was a dollar that could not be invested in a wonderful business like American Express or Coca-Cola. A single dollar invested in a business earning 5% per year for 20 years becomes $2.65. That same dollar, invested in a great business earning 20% per year, becomes $38.34. The difference is not linear, it is exponential. The ego tax isn't just the money you lose on the bad investment. It's the colossal future wealth you forfeit by keeping your capital imprisoned in a failing enterprise. On a portfolio level, this translates into a phenomenon known as the garden of weeds. An investor who refuses to admit mistakes will, over time, end up with a portfolio where the losing positions, the weeds, are never pulled. They are held on to, rationalized, and sometimes even added to. Meanwhile, the truly great businesses, the flowers, are often sold too early to lock in a small gain, another ego-driven move to feel the thrill of being right. The end result is a portfolio full of struggling, capital-intensive businesses and a cash account that once held shares of world-beating compounders. This is the direct, tangible outcome of letting ego drive your sell decisions. Your balance sheet becomes a museum of your past mistakes. A disciplined investor, free from the ego's prison, does the opposite. They systematically sell their mistakes to free up capital, a process Charlie Munger colorfully describes as taking your best ideas and betting heavily on them. This allows them to feed their flowers and pull their weeds. The financial connection is stark and unforgiving. One path leads to a portfolio that gets progressively worse over time, dragged down by the dead weight of past errors. The other leads to a concentrated portfolio of high-quality assets, where capital is efficiently recycled from mistakes into opportunities. Over an investing lifetime, the difference in these two approaches is not a matter of a few percentage points. It is the difference between modest savings and true, generational financial freedom. Once an investor has begun the difficult work of dismantling their ego, the next stage of evolution is to move from private admission to systematic analysis. It's not enough to simply feel bad about a mistake. One must deconstruct it with the precision of a surgeon. This is where Warren Buffett elevates himself from a merely humble investor to a master of self-improvement. He doesn't just admit his errors, he performs a public post-mortem, laying out his flawed reasoning in his annual letters for millions of shareholders to scrutinize. This act of radical transparency is not for show. It is a powerful psychological device for enforcing intellectual honesty and ensuring that a lesson, once paid for, is never forgotten. His most painful and instructive public confession revolves around a folksy shoe company from Maine. The foundational anecdote takes us to 1993. Berkshire Hathaway was a powerhouse, and Buffett was at the top of his game. He was on the hunt for large, high-quality businesses to acquire. He found one in Dexter Shoe Company. On the surface, it had all the hallmarks of a classic Buffett business. It was a long-established American brand, it produced a quality product, it was consistently profitable, and it was run by an excellent family management team. Most importantly, Buffett believed it possessed a durable competitive advantage, a moat. He thought Dexter's brand and manufacturing prowess would protect it from foreign competition. He was so confident, in fact, that he did something highly unusual for him. He bought the company not with cash, but with Berkshire Hathaway stock. He paid $433 million, which equated to 203 shares of Berkshire Class A. At the time, it seemed like a standard, solid acquisition. But his analysis was deeply flawed. The moat he thought he saw was a mirage. Shortly after the acquisition, the forces of globalization, which had already decimated the textile industry he knew so well, came for the American shoe business. Cheaper foreign labor made it impossible for Dexter to compete on price. Their profits evaporated. The durable competitive advantage proved to be anything but durable. The business went into a terminal decline, and eventually, its economic value went to zero. Now, many CEOs would have buried this mistake. They would have written off the asset quietly, tucked it away in a complex financial report, and never spoken of it again. Buffett did the opposite. He began a multi-decade public flogging of himself. In his 1999 letter, he wrote, "I've made more mistakes than you can imagine. The terrible Dexter shoe deal. I bought a business that was destined to disappear." But he didn't stop there. He twisted the knife further, explaining the true magnitude of his error. The mistake wasn't just buying a worthless company. The catastrophic error was using Berkshire stock to do it. The 203 shares of Berkshire he had traded away for Dexter Shoe, which became worthless, continued to compound in value. In his 2007 letter, he revisited the mistake, calculating that those shares were now worth $3.5 billion. He wrote, "As a financial disaster, This one deserves a spot in the Guinness Book of World Records. I gave away 1.6% of a wonderful business to buy a worthless business. He brought it up again in his 2014 letter, by which time the value of the stock he had squandered was over $5.7 billion. He called the decision, quote, "the worst deal that I've made." By dissecting this mistake so openly and repeatedly, Buffett wasn't just apologizing. He was cementing the lesson deep in his own psyche and in the minds of his shareholders. The lesson: when you use your own highly valuable stock to buy another company, you are not just making a purchase. You are making a statement that the asset you are acquiring is as good or better than your own. To be wrong in that assessment is to commit an unmitigated financial crime against your own shareholders, a crime for which he had found himself guilty. This public post-mortem ensured that he, and anyone who read his letters, would think much, much harder before ever again trading a magnificent asset for a mediocre one. The psychological engine driving Buffett's practice of public post-mortems is a direct assault on two of our most self-deceptive cognitive biases: hindsight bias and the self-serving bias. Hindsight bias is the "I knew it all along" phenomenon. After an event occurs, our brain has a powerful tendency to believe that we predicted it in advance. If a stock we sold goes to zero, we misremember our original uncertainty and tell ourselves, "I knew that company was a dog." This bias prevents us from learning because it rewrites history, making us seem more prescient than we actually were. It robs us of the opportunity to analyze our tactual state of mind at the time of the decision. The self-serving bias is its insidious partner. This is our tendency to attribute our successes to our own skill and talent, while attributing our failures to external factors and bad luck. When we pick a winner, it's because we're brilliant analysts. When we pick a loser, it's because of the Fed, the market, or a surprising news event. Buffett's written public analysis short-circuits both of these biases. By writing down his original thesis for buying Dexter's shoe, that it had a durable competitive advantage, and then publicly stating why that thesis was wrong, he creates an unchangeable, objective record. He cannot later claim, "I knew foreign competition was a risk all along." The record is there, in black and white. He is forced to confront the gap between his prediction and reality. This act of public commitment creates a powerful form of accountability. Social psychologists have long known that when we state a belief or a goal publicly, we are far more likely to remain consistent with it. In this case, Buffett is making a public commitment to intellectual honesty. He is telling the world, "I made a specific analytical error, and I am now holding myself accountable for it." This rewires the brain's natural impulse. Instead of seeking to protect the ego by blaming luck, the brain is now engaged in a problem-solving exercise. What was the flaw in my process, and how do I prevent it from happening again? The public nature of the admission raises the stakes, making the lesson more painful, more memorable, and therefore more potent. It transforms a vague feeling of regret into a concrete, analyzable data point, a crucial step in moving from an amateur mindset to one of professional decision-making. To systematize this powerful practice, we need a mental model, a replicable blueprint that we can apply to our own investment mistakes. The most effective framework is one borrowed from other high-stakes professions that cannot afford to ignore errors: the aviation industry's black box thinking, or the U.S. Army's after-action review, AAR. The core principle is the same: a blame-free, process-focused deconstruction of what went wrong, designed to produce actionable lessons for the future. The blueprint for conducting your own investment AAR consists of 4 distinct steps, which should be meticulously documented in an investment journal. Step 1. State the original intent. Before you analyze the outcome, you must go back to your notes, which you made before you bought the security, and clearly restate your thesis. What was the exact reason you bought the investment? What did you expect to happen? What were the key drivers you identified? For Buffett and Dexter's shoe, the intent was to acquire a consistently profitable company with a durable competitive advantage that would provide stable earnings for Berkshire Hathaway for decades to come. Step 2. What actually happened? This section is for objective facts only, no opinions, no rationalizations, just the data. I purchased Dexter Shoe in 1993 for $433 million in Berkshire stock. Over the subsequent years, foreign competition eroded its pricing power, and its profits declined steadily. The economic value of the business operations eventually fell to zero. Step 3. What were the key contributing factors? This is the core of the analysis. Here you explore the asterisk why, the nas time. You must ask a series of probing questions. Why did the outcome diverge from the intent? Was there a flaw in my original analysis? Did I misjudge the company's competitive position? Did I fail to anticipate a major industry shift? Did an unexpected external event occur? Crucially, you must then ask, should I have been able to foresee this? In Buffett's case, the answer would be, the primary contributing factor was a gross misjudgment of the company's competitive moat. I underestimated the power of globalization and cheap foreign labor. Given my previous experience with the terminal decline of the New England textile industry, this was not an unforeseeable risk. It was a failure of imagination and an error in applying lessons I had already learned. Step 4. What will we do differently next time? This is the most important step. The entire exercise is useless if it does not produce a concrete change in your future process. The goal is to create a new rule, a new checklist item, or a new mental habit. For Buffett, the lesson from Dexter produced several new rules. One was the immense danger of using highly valued stock to make acquisitions. Another, more subtle rule was to be hyper-vigilant about seemingly stable, old-line manufacturing businesses in an era of accelerating globalization. Your rule might be something like, for any company that relies on a brand moat, I must now conduct a specific analysis of its vulnerability to low-cost international competition. This transforms the mistake from a painful memory into a productive asset, a new, improved piece of your investment process. The antithesis to this rigorous, systematic review is the path of the silent loser. This is the investor who operates under a veil of secrecy and curated success. They are the ones you see on social media or at cocktail parties who only ever talk about their winners. Their investment in Apple that went up tenfold is discussed at length. Their disastrous bet on a speculative biotech company that went bankrupt is never mentioned. It's as if it never happened. Their portfolio becomes a hidden graveyard of bad decisions, a financial record of sins that are never confessed and therefore never absolved. This behavior creates a dangerously distorted feedback loop. By only acknowledging their successes, they attribute all positive outcomes to their own skill, reinforcing a narrative of their own genius. This leads to massive overconfidence, the most toxic of all investor traits. They develop no mechanism for learning. Since failures are either ignored or blamed on external factors, the underlying process flaws, the tendency to chase hot stocks, the failure to do proper due diligence, the inability to manage risk, are never identified and never corrected. They are like a pilot who, after a near miss in the air, refuses to file a report and instead just tells everyone what a great pilot they are for landing the plane safely. They have learned nothing that will prevent a future, potentially fatal, crash. This curation of a successful persona also makes them incredibly susceptible to herd behavior. They want to be associated with the winning names, the stocks everyone is talking about. So they pile into crowded trades, often at the peak, because the social proof is overwhelming, and the desire to be part of the winning team eclipses any independent analysis. The path of the silent loser is a path of stagnation. They may have years of market experience, but they have very little market wisdom, because wisdom is forged only in the crucible of honestly analyzed failure. They are doomed to make the same amateur mistakes in their 10th year of investing as they did in their first, forever wondering why their results never seem to match their self-proclaimed intelligence. The direct financial connection of adopting a public or at least a documented post-mortem process is the concept of error rate compounding. Just as our financial returns compound over time, so do the consequences of our uncorrected errors. Imagine two investors, both starting with the same amount of capital and the same initial skill level. Let's say they both have a process that has a 10% error rate, meaning 1 out of every 10 of their decisions contains a significant analytical flaw. Investor A is a silent loser. He ignores his mistakes and learns nothing. His error rate remains stuck at 10% for his entire 30-year investing career. Investor B, however, adopts the after-action review process. After every single mistake, she identifies the flaw and creates a new rule. Her process improves. After the first few mistakes, her error rate drops from 10% to 9%. A few mistakes later, it's 8%. This seems like a small improvement, but over 30 years the effects are cataclysmic. Investor A, with a constant 10% error rate, will suffer periodic significant drawdowns from which he may never fully recover. A single uncorrected flaw, like the tendency to average down on losers, can lead to a portfolio crippling loss that sets him back a decade. His long-term compound annual growth rate is severely damaged by these recurring predictable mistakes. Investor B, on the other hand, sees her portfolio's resilience grow each year. As she systematically eliminates flaws in her process, she avoids the catastrophic errors that plague Investor A. Her drawdowns are shallower. Her recovery is faster. Her compound annual growth rate is not only higher, but also more consistent. The small 1% or 2% improvement in her annual return, which resulted from a continuously decreasing error rate, compounds into a fortune. After 30 years, the difference in their final wealth will not be 10% or 20%. It will likely be an order of magnitude. Investor B's portfolio might be several times larger than Investor A's. This is the ultimate financial payoff of radical transparency with oneself. It is the mathematical certainty that a process that learns from its mistakes will, over the long run, demolish a process that is too arrogant to learn. At the heart of a sophisticated investment philosophy lies a crucial distinction, a concept that separates the amateur from the professional. It is the ability to separate the quality of a decision from the quality of its outcome. Our minds are naturally wired to merge the two. If we make money, it was a good decision, and if we lose money, it was a bad one. This is known as outcome bias, and it is a treacherous guide to self-improvement. Warren Buffett's career is a masterclass in fighting this bias. He understands that in a world governed by both skill and luck, one can make a brilliant decision that, through sheer chance, leads to a poor result. Conversely, a terrible, reckless decision can be rewarded by dumb luck. The key to long-term success is to obsess over the quality of your process, not the short-term noise of the outcome. The foundational anecdote that perfectly encapsulates this doctrine is his legendary investment in the Washington Post Company in 1973. This was not a story of immediate gratification, it was a trial by fire that tested his commitment to his own process. The market context was bleak, the Nifty 50 bubble had burst, and the American economy was mired in stagflation. The stock market was in a deep and prolonged bear market. Pessimism was rampant. The Washington Post, despite being a premier media franchise with a near monopoly in its market, saw its stock get decimated. The entire company's market capitalization fell to around $80 million. Buffett, executing his process, analyzed the business with meticulous care. He wasn't looking at the stock chart, he was looking at the underlying economics of the business. He realized that one could sell off the company's television stations and other assets for more than the entire $80 million market cap, meaning he would get the flagship newspaper, a world-class, profitable enterprise, for less than free. The business was durable, it was run by the brilliant and honest Katharine Graham, and it was trading at a ludicrously cheap price. By every metric of his value investing process, it was a fantastic decision. So he started buying. He invested over $10 million, acquiring a huge stake in the company. And what happened next? The stock went down. The market continued to fall, and the value of his investment declined by another 20 to 25%. An outcome-oriented investor would have panicked. They would have concluded, "I lost money, therefore I made a bad decision." They would have questioned their analysis and likely sold at a loss, convincing themselves they had narrowly escaped a bigger disaster. But Buffett focused on his process. He asked himself, has the underlying value of the business deteriorated? No. Is the management still excellent? Yes. Is the price now even more attractive than when I first bought it? Yes. His process was sound. The market's short-term reaction, the outcome, was irrelevant noise. He knew that the connection between a company's intrinsic value and its stock price can be stretched by market psychology, but eventually, value is recognized. He held on with conviction, and he was right. As the market recovered, the Washington Post stock soared. His initial $10 million investment grew to be worth over $1 billion by the mid-2000s, a hundredfold return. It became one of the cornerstone investments of his career. This triumph was not a victory of stock picking. It was a victory of process. It was the result of having a robust, logical framework and the psychological fortitude to trust that framework, even when the short-term outcome was painful and screamed that he was wrong. The cognitive trap that Buffett sidestepped with the Washington Post is outcome bias, one of the most pervasive and damaging shortcuts in human judgment. Our brain is a machine for conserving energy, and judging a decision by its result is incredibly efficient. It's a simple binary check. Profit equals good decision, loss equals bad decision. This works reasonably well in highly predictable environments. If you touch a hot stove and get burned, the outcome reliably tells you it was a bad decision. But investing operates in a probabilistic, not a deterministic world. It's more like poker than chess. In chess, the better player almost always wins. In poker, the better player can make all the right decisions, calculating the odds perfectly, reading their opponents, and still lose a hand due to the luck of the draw. If a great poker player judges their skill based on the outcome of a single hand, they will go insane. They must judge themselves on the quality of their decisions given the information they had at the time. Investing is the same. A well-researched investment in a wonderful company can be derailed by an unpredictable event, a pandemic, a new technology, a sudden geopolitical crisis. A wild, speculative bet on a company with no revenue and a flimsy business plan can be rewarded if they happen to get bought out. The outcome-oriented investor learns the wrong lessons from both scenarios. The lucky win reinforces a bad process, gambling, making them more likely to repeat it until their luck inevitably runs out. The unlucky loss punishes a good process, diligent research, making them more likely to abandon a sound strategy in favor of chasing whatever is currently working. This is the path to ruin. To escape this trap, we have to mentally decouple the decision from the outcome. We must have the intellectual maturity to say, I conducted a thorough analysis and made a good decision, but a low probability event occurred, and I had a bad outcome. I will stick to my process. And even more difficult, we must be able to say, I took a reckless gamble without any real research and got lucky with a good outcome. I must recognize this as dumb luck and not repeat the behavior. This separation is the foundation of long-term thinking and a cornerstone of sound behavioral finance. To implement this sophisticated way of thinking, we need an applied mental model that allows us to systematically categorize our decisions, separating process from outcome. The most effective tool for this is the 2x2 decision matrix. Imagine a square divided into 4 quadrants. The horizontal axis represents the quality of the outcome, from bad to good. The vertical axis represents the quality of your process, from bad to good. Every investment decision you make will fall into one of these 4 boxes. The blueprint is to create a habit of retrospectively placing every major investment into this matrix. Quadrant 1. Good process, good outcome. This is a deserved success. You did your homework, your thesis was correct, and you were rewarded with a profit. Buffett's purchase of See's Candies falls here. The lesson is to analyze what worked and reinforce that process. Quadrant 2. Good process, bad outcome. This is bad luck. You did your homework, your thesis was sound, but an unpredictable external event caused a loss. Buffett's investment in the Washington Post temporarily lived here. The critical lesson here is to *, not homo, change your sound process. You must have the conviction to recognize that in a probabilistic system, this quadrant is unavoidable. You learn about the nature of risk, but you don't abandon your strategy. Quadrant 3, bad process, good outcome. This is dumb luck. This is the most dangerous quadrant of all. You took a flyer on a tip from a friend. You bought a stock because the name sounded cool. You engaged in reckless speculation, and you happened to make money. An undisciplined investor celebrates this as a sign of their innate genius. A disciplined investor recognizes it as a near miss with disaster. The lesson is to identify the flawed process and vow never to repeat it, regardless of the positive outcome. Quadrant 4, bad process, bad outcome. This is poetic justice, or a learning opportunity. You were reckless, and you were punished for it. Your process was flawed, and the outcome confirmed it. This is the easiest quadrant to learn from, but only if you are honest about the bad process that led you there. To use this matrix effectively, you first need to define what a good process means for you. This involves creating a detailed investment checklist. Does your process require you to understand the business model, analyze the last 5 years of financial statements, assess the management team, calculate a conservative intrinsic value, and ensure a margin of safety? By writing down your process, you create an objective yardstick against which you can judge your decisions. After every investment is closed out, you force yourself to analyze it through this matrix. This simple habit moves you from a world of emotional reactions to outcomes into a world of logical refinement of your process, the true path to becoming a better investor. The world is filled with the casualties of the opposite approach, the path of the 99%, the results-oriented investor. This individual is a slave to the whims of the market and the tyranny of the last outcome. Their entire investment philosophy is a reactive loop, devoid of any stable underlying principles. Let's follow their journey. In a raging bull market, they throw money at speculative growth stocks with no earnings. The stocks go up. The outcome is good. They conclude their process, which was essentially gambling, is brilliant. They become evangelists for this strategy, scoffing at the old-fashioned principles of value investing. They have fallen into the dumb luck quadrant and mistaken it for genius. Then, the market turns. Their high-flying stocks crash. The outcome is now terrible. A process-oriented investor would analyze the risk they had taken on. The results-oriented investor, however, simply concludes that their strategy is now broken. They abandon it completely. Panicked, they look around for what is working now. Perhaps defensive, dividend-paying stocks are holding up better. So they sell their speculative stocks at the bottom and pile into dividend stocks, just as those stocks are becoming overvalued. They have reacted to a bad outcome by completely changing their approach, chasing performance from one strategy to another. They are perpetually buying high and selling low, not on the scale of individual stocks, but on the scale of entire investment styles. Their process is to have no process. They are a leaf in the wind of market sentiment. If a well-researched value stock they own goes down during a recession, they lose faith in the entire concept of value investing. They don't have the bedrock of the process over outcome doctrine to anchor them. They are constantly whipsawed emotionally and financially because their only measure of success is the last tick of the stock market ticker. This is an exhausting and ultimately impoverished way to invest. It guarantees mediocrity because it prevents the one thing that leads to mastery: the consistent application and refinement of a sound, repeatable process. The direct financial connection between a process-driven philosophy and long-term wealth is deeply tied to the concepts of risk management and volatility drag. The results-oriented investor, emboldened by a string of lucky outcomes, often takes on enormous, hidden risks. They might be heavily concentrated in a single speculative industry, or using excessive leverage because it worked for them in the past. Their portfolio is incredibly fragile, like a beautiful vase balanced precariously on the edge of a table. It looks fine until a small, unexpected shock, a black swan event, comes along and shatters it. The financial consequence of a bad process is not a series of small losses, but the high probability of a single, catastrophic portfolio-ending loss. We saw this in the dot-com bust, where portfolios built on the dumb luck of the late 90s were wiped out in a matter of months. We saw it again in 2008 with investors who were over-leveraged in real estate. One single massive drawdown can erase a decade of gains and psychologically scar an investor for life. A process-oriented investor, by contrast, builds a portfolio that is robust. Their checklist and principles, like requiring a margin of safety, demanding a circle of competence, and diversifying appropriately, are specifically designed to protect against the unknown and the unlucky. Their focus is not just on generating returns, but on managing risk. This leads to a portfolio that is less volatile. And this is where the mathematics of volatility drag becomes critical. A portfolio that goes up 50% one year and down 40% the next has an average annual return of 5%, but its actual compound annual growth rate is 0. The volatility has dragged the real return down. A less volatile portfolio that returns a steady 10% each year will end up with far more money. The process-driven investor's focus on risk management leads to smoother returns, which allows the engine of compounding to work its magic with fewer interruptions. The financial advantage is not just defensive, it's offensive. By avoiding the catastrophic losses that cripple the results-oriented gambler, the process-driven investor ensures they are always in the game, steadily compounding their capital towards their goal of financial wisdom and independence. As we progress on this journey of self-improvement, we move from overcoming ego and refining our process to achieving the ultimate state of an investor's mindset, anti-fragility. This is a concept that goes beyond mere resilience. The resilient investor can withstand a shock. They can take a punch and get back up. The anti-fragile investor, however, gets stronger from the shock. They feed on volatility, chaos, and, most importantly, the mistakes of others. They have built a system of learning from their own past errors that allows them to recognize and capitalize on the errors currently being made by the market at large. Warren Buffett's career is the ultimate testament to an anti-fragile mind, a mind that transforms market panic into generational opportunity. The foundational anecdote for this principle is one of the most daring bets of Buffett's early career, his investment in American Express during the salad oil scandal of 1963. The story begins with a small company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. DeAngelis had devised a massive fraud. His company would take out huge loans from banks, using his inventory of salad oil as collateral. American Express had a field warehousing division that would inspect the inventory and issue receipts guaranteeing its existence. These receipts were trusted implicitly by Wall Street. The problem was, the salad oil didn't exist. DeAngelis filled his giant tanks mostly with water, with only a thin layer of oil on top. When inspectors came, they saw what they expected to see. The fraud was enormous, totaling what would be over $1.5 billion in today's money. When it was exposed, Allied Crude went bankrupt and panic erupted. Wall Street believed that American Express, which had guaranteed the non-existent inventory, would be on the hook for all the losses and would be driven into bankruptcy itself. The market was terrified. The stock of American Express, a blue-chip institution, collapsed by nearly 50%. This was disorder, chaos, and a massive market-wide error in judgment. This is where Buffett's anti-fragile mind went to work. A fragile investor would have sold any Amex stock they owned in a panic. A resilient investor might have held on, hoping for a recovery. Buffett, however, saw the panic as a signal of opportunity. His past mistakes had taught him that the market often overreacts, confusing a temporary problem at a single division with a mortal wound to an entire franchise. His process kicked in. He didn't just look at the balance sheet. He went out and did the real-world scuttlebutt research. He visited restaurants and banks. He talked to merchants. He personally observed customers using American Express travelers' checks and credit cards. He was looking for one thing. Had the scandal damaged the core business? Had the public lost faith in the American Express brand? The answer was a resounding no. Customers were still using the products, and merchants were still accepting them. The scandal was contained to the warehousing division. The powerful consumer-facing moat was completely intact. He realized the market was making a colossal mistake, pricing the company as if it were going to die when its crown jewel business was unharmed. So he acted. He invested 40% of his partnership's capital, a massive conviction-weighted bet, into American Express stock. As the company settled the fraud claims for far less than the market feared, and its core business continued to churn out profits, the stock roared back. Buffett made a fortune. He didn't just survive the chaos, he profited from it. The market's error became his fuel. This is the essence of an anti-fragile investor. They have a process, honed by the analysis of past mistakes, that allows them to be the calm, rational buyer when the rest of the world is selling in a blind panic. The deep psychological principle at play here is anti-fragility, a term coined and brilliantly explored by the writer and risk analyst Nassim Nicholas Taleb. Taleb argues that we often think in a limited spectrum of fragility and robustness. A glass cup is fragile. Under stress, it breaks. A steel bar is robust. Under stress, it remains unchanged. But there is a third category that is far more interesting and powerful: the anti-fragile. The anti-fragile is something that gains from disorder. The classic example is the human immune system. When exposed to a small dose of a pathogen's stress, it doesn't just recover. It develops antibodies and becomes stronger, better prepared for future attacks. In psychology, this is known as post-traumatic growth, the phenomenon where people who endure significant adversity often report positive changes in their lives, developing a deeper appreciation for life, greater personal strength, and new possibilities. Learning from investment mistakes is the direct mechanism for developing an anti-fragile investing mind. Each error, when properly dissected, acts like a vaccine. The pain of the loss inoculates you against making the same mistake again. When you make the mistake of buying into a speculative bubble and getting burned, you develop an antibody against herd behavior and FOMO. The next time a bubble inflates, you are not tempted, you are immunized. When you make the mistake of panic selling during a crash and locking in losses, you develop an antibody against fear. The next time the market plummets, you see opportunity, not terror. This systematic learning process transforms stressors from threats into information. A market crash is no longer a source of pain. It is a source of data, signaling that the market is making a large-scale, fear-driven error that you are now psychologically equipped to exploit. You have, through the deliberate practice of analyzing your failures, strengthened your mind to the point where it no longer breaks or even just endures stress, but actually requires it to thrive. The applied mental model that serves as the blueprint for building this anti-fragile mindset is the diligent cultivation of your circle of competence. This concept, central to the Buffett-Munger philosophy, holds that every investor has a limited area of expertise. True wisdom lies not in having a massive circle, but in knowing precisely where the borders of your circle lie and never straying outside of them. Your investment mistakes are the most reliable tool for mapping these borders. The blueprint is a continuous, iterative process of definition and refinement. Step 1. Define your current circle. Be brutally honest with yourself. What industries, business models, and financial structures do you understand with deep, intimate knowledge? Can you explain how the business makes money, what its key variables are, and what its competitive landscape looks like, as well as you can explain your own profession? Write it down. For most people, this circle is very small, and that is perfectly fine. Step 2. Analyze your mistakes through the lens of your circle. For every investment that has gone wrong, ask the simple question: was I operating inside or outside my circle of competence? The answer is often revealing. The disastrous bet on the complex biotech company, the failed speculation on currency futures, the investment in a retailer whose business model you didn't truly grasp. These are almost always ventures outside the circle. Step 3. Use the mistake to reinforce or expand the circle. This is the crucial anti-fragile step. When you identify a mistake made outside your circle, you have two choices. The first is to reinforce the border. You can create a hard and fast rule. I will never again invest in early-stage biotech companies because I do not have the scientific expertise to evaluate them. This makes your circle smaller, but also stronger and more well-defined. The second option is to consciously expand your circle. You might decide, I lost money on that retailer because I didn't understand inventory management. I will now dedicate the next 6 months to studying the business of retail, reading annual reports, and talking to experts until it is legitimately inside my circle. This process turns your mistakes into a personalized map of your own ignorance. Each loss becomes a signpost pointing to a weakness in your knowledge. Over time, you build a fortress of deep expertise, hardened by the lessons of your past failures. This allows you to act with extreme confidence and decisiveness when an opportunity appears inside your circle, like Buffett did with American Express, precisely because you have learned the discipline to ignore the tempting siren songs from outside of it. The antithesis of the anti-fragile investor is the fragile investor. Their psychology and their portfolio are as brittle as spun glass. The fragile investor has never built a system for learning from their errors. As a result, each mistake doesn't strengthen them, it weakens them, leaving a psychological scar that degrades their future decision-making. A large loss from a single stock doesn't teach them about proper diversification. It makes them terrified of all individual stocks. They get burned by a speculative craze, and instead of learning to identify the signs of a bubble, they conclude that, quote, the stock market is just a casino, a belief that robs them of a lifetime of compounding growth. Their ego is equally fragile. Because they cannot admit mistakes, their confidence is a house of cards. It is built on a recent string of lucky wins. When the inevitable market downturn comes, their confidence is shattered completely. This fragility leads to two disastrous outcomes. Many become permanently risk-averse. They are the investors who, after being burned in the 2008 crash, kept their life savings in cash or low-yield bonds for the next decade, missing one of the greatest bull markets in history. Their mistake made them weaker, more fearful, and ultimately poorer. The other type of fragile investor breaks in the opposite direction. A large loss makes them desperate to win it back. They start taking on even more risk, engaging in reckless revenge trading, turning a manageable loss into a life-altering financial catastrophe. In both cases, the stressor, the market loss, has destroyed them. They lack the mental framework to process the mistake, extract a lesson, and use it to build a stronger, more resilient system. They are doomed to be the victims of market volatility, forever reacting to chaos rather than learning to profit from it. The direct financial connection of an anti-fragile mindset is profound, and it can be summed up in 2 words: crisis alpha. Alpha is the investment term for returns generated above and beyond the market average. Crisis alpha is the massive outperformance that can be achieved by having the capital and the courage to invest during periods of maximum pessimism. The fragile investor liquidates their assets during a crash, guaranteeing they receive the worst possible returns. The anti-fragile investor, whose mindset has been forged in the fire of past analyzed mistakes, sees a crisis as a once-in-a-decade sale. They have learned from their mistake of panic selling in the past. They have learned from their mistake of not having cash ready to deploy. They have built a system, both psychological and financial, to exploit these events. Let's quantify this. An investor who put $100,000 into an S&P 500 index fund at the market peak in October 2007 would have seen their investment fall to around $50,000 by the bottom in March 2009. The fragile investor sells at the bottom, locking in a 50% loss. The resilient investor holds on and eventually gets back to even a few years later. But the anti-fragile investor, who had cash waiting, invests their $100,000 at the bottom in March 2009. By 2019, that $100,000 would have grown to over $400,000. This is the tangible, life-changing financial power of a mindset that gains from disorder. It's not just about making money, it's about making the bulk of your generational wealth during the very moments when the vast majority of people are losing theirs. This ability is not an innate talent, it is a skill, and it is learned. It is the direct financial reward for years of disciplined, humble, and rigorous analysis of your own failures. We have now journeyed from the psychological prison of the ego to the liberating mindset of anti-fragility. We understand why we must analyze our mistakes, how to deconstruct them, and what ultimate state of mind we are trying to achieve. The final pillar is the most practical. It is the bridge between theory and action. It is the specific tool that enables this entire process of self-improvement. The investment journal. This is not merely a record of trades. It is a personal laboratory for financial wisdom, a place to conduct the experiments, document the failures, and ultimately codify the laws of your own investing success. While Warren Buffett may not keep a handwritten diary titled My Investment Journal, his entire public life's work serves the same function. His collection of annual letters to Berkshire Hathaway shareholders is one of the most magnificent investment journals ever created. It is a real-time record of his evolving thoughts, his successes, his failures, and the lessons learned over more than 50 years. A perfect anecdote illustrating this evolution, this process of learning and documentation, is the story of his investment in See's Candies in 1972. This was a pivotal moment, not just for the profit it generated, but for the profound lesson it taught him and Charlie Munger, a lesson that was a direct result of almost making a huge mistake. At the time, Buffett was still very much in the cigar butt mode of investing, looking for statistically cheap, fair companies. See's Candies was not a fair company. It was a wonderful company. It had a beloved brand, tremendous customer loyalty, and pricing power. But it was not statistically cheap. The sellers wanted $30 million, and Buffett's analysis concluded it was worth no more than $25 million. He and Munger were on the verge of walking away from the deal over a few $1,000,000. It was Charlie Munger who pushed him. Munger argued that they needed to break out of their old framework. He understood that a truly great business with a durable moat was worth paying a higher price for. Its ability to grow and generate cash over decades would more than justify the premium. Reluctantly, Buffett agreed. They paid the higher price. See's Candies went on to become an unbelievable financial success, generating over $2 billion in pre-tax earnings for Berkshire on that tiny initial investment, and it required very little additional capital. But the real return was the lesson. Buffett has written and spoken about this repeatedly. The experience with See's Candies completely rewired his brain. It was the crucial data point that shifted him from buying, quote, fair companies at wonderful prices to buying, quote, wonderful companies at fair prices. This lesson, learned from a near mistake, became a cornerstone of his new philosophy. He documented this shift in his letters, explaining how See's taught him the immense value of intangible assets, like brand loyalty. And this lesson, forged and documented in 1972, directly paved the way for his massive, company-making investment in Coca-Cola in 1988. Without the near failure and subsequent learning from See's, the Coca-Cola investment, which has generated billions upon billions in value, might never have happened. His letters served as the journal, codifying the lesson and making it a permanent part of Berkshire's institutional DNA. The psychological principle that makes an investment journal so potent is the concept of deliberate practice. Coined by psychologist Anders Ericsson, this is the idea that expertise is not developed through simple repetition, but through a specific type of practice that involves focused attention, feedback, and continuous refinement. Playing tennis for 1,000 hours might make you a decent player, but 1,000 hours of practice with a coach, focusing specifically on your weak backhand, getting immediate feedback, and making incremental adjustments, that is what creates a champion. An investment journal is the tool for deliberate practice in the solitary game of investing. It is your personal coach. When you simply invest without a journal, you are just repeating actions. When you document your thesis beforehand and analyze your results afterward, you are creating a feedback loop. You are identifying your specific weaknesses, your weak backhand, which might be a tendency to sell winners too early or an inability to properly assess debt levels. The journal allows you to focus your learning on these specific areas. This process is also a powerful antidote to the forgetting curve, a concept from Hermann Ebbinghaus that shows how information is lost over time when we make no attempt to retain it. The human mind is terrible at remembering the details and emotional context of past decisions. Weeks after you buy a stock, your memory of the original thesis will become vague and likely colored by the stock's subsequent performance. The journal creates a permanent, objective record, freezing the moment of decision in time. It prevents you from rewriting history in your mind, forcing you to confront your actual reasoning, not your revised, hindsight-biased version of it. By forcing you to write, it also forces clarity of thought. The act of translating a vague investment idea into clear, written sentences exposes flimsy logic and unexamined assumptions. It is the ultimate tool for turning passive experience into active, cumulative wisdom. Now, let's build the blueprint. This is not a diary for your feelings. It is a rigorous, scientific logbook. A proper investment journal should be divided into 3 distinct sections, creating a full life cycle for every investment decision. Section 1. The pre-mortem. This is to be completed times before times you purchase a single share. It contains all the key information about your decision. It must include the date, the company name, and the stock ticker, the current price and the size of the position you intend to take, your complete, detailed investment thesis, written out in several paragraphs. Why are you buying this? What is your edge? What do you believe you understand that the market is missing? Next, a list of the key variables and metrics you will track. What are the 2 to 3 things that must go right for your thesis to play out? Then, your valuation work. What is your conservative estimate of the company's intrinsic value? What methodology did you use? DCF, multiples, etc. Show your work. Finally, and most critically, your exit criteria. Write down the price target at which you will consider selling if you are right. And write down the specific conditions or a stop-loss price at which you will automatically sell if you are proven wrong. This is your pre-commitment to rational action. Section 2. The post-mortem. This section is completed only after you have sold the position. You will pull up your original pre-mortem entry and conduct your after-action review. Restate your original thesis. Then, analyze the outcome with brutal honesty. Where were you right? Where were you fundamentally wrong? Did you misjudge the industry, the management, the valuation? Was this a process error or simply bad luck? Categorize it using the 2x2 matrix. The final and most important part of this entry is a single sentence that begins with, "The primary lesson from this investment is," you must distill the entire experience down to one potent, memorable takeaway. Section 3. The Book of Rules. This is a separate, running document. It is the constitution of your investment philosophy. Every time you complete a post-mortem and derive a primary lesson, you transfer that lesson to your book of rules. For example, after a painful loss on a heavily indebted company, your post-mortem lesson might be, the primary lesson is that high levels of debt can turn a moderate business downturn into a catastrophic risk of bankruptcy. You then add a new rule to your book of rules. Rule number 17. Never invest in a company with a debt-to-equity ratio above 2.0 without a truly extraordinary reason. Over years of investing, this book will grow into your personal Bible, a collection of hard-won wisdom that you have paid the market to learn. It becomes the ultimate checklist to consult before every future decision, ensuring you never pay for the same lesson twice. The antithesis to the journaling investor is the intuitive investor. This is the 99%. They operate on gut feelings, hot tips from their brother-in-law, and the vague, unreliable narrative of their own memory. Their decision-making process is a complete black box, even to themselves. If you ask them why they bought a particular stock, they might say something like, "I just have a good feeling about it," or "It's in a hot sector." There is no written thesis. There is no valuation work. There are no predefined exit criteria. They are essentially driving blindfolded, relying on instinct in a game that mercilessly punishes a lack of discipline. When one of their investments goes sour, they have no framework for learning. They cannot review their original thesis because one never existed in a concrete form. Their memory of why they bought it is now hopelessly contaminated by the negative outcome. So what do? They blame. They blame the market manipulators, they blame the high-frequency traders, they blame the Fed, they blame the crooked CEO. Their ego remains perfectly shielded because there is no objective record of their own decision-making to hold them accountable. They are doomed to a career of what is known as a random walk. Their results will be dictated by luck, not skill, because they have no mechanism for skill development. Each decision is an isolated event, disconnected from the past and offering no wisdom for the future. They are on an endless loop of trial and error, mostly error, forever paying tuition to the market but never bothering to show up for class. Their journey is not one of self-improvement, but one of slow, or sometimes rapid, financial erosion. The direct financial connection of keeping an investment journal is the systematic refinement of your personal edge. In the competitive arena of the stock market, you can only achieve superior returns if you have some kind of advantage over the average participant. This edge could be informational, you know something others don't, analytical, you interpret public information better than others, or behavioral, you have more discipline and patience than others. Your investment journal is the single most powerful tool for identifying and sharpening your edge. The post-mortem section of your journal will, over time, reveal clear patterns in your behavior. You might discover, wow, 80% of my biggest losses have come from trying to pick the bottom in turnaround stories. This is an invaluable piece of self-knowledge. You have just identified a major leak in your financial boat. By codifying this into a rule in your book of rules, rule number 21, avoid turnaround stories completely. You have just permanently plugged that leak. This systematic plugging of your personal leaks translates directly into a higher compound annual growth rate, CAGR. Let's quantify it. Suppose your journaling reveals that your tendency to sell your winning stocks too early to lock in a gain is costing you, on average, 1.5% in annualized returns per year. That sounds small, but over a 30-year investing career, the difference between compounding your capital at 8.5% versus 10% is monumental. On an initial investment of $100,000, a 10% return gives you $1,744,940. An 8.5% return gives you only $1,155,821. That's a difference of nearly $600,000. That is the direct financial reward for identifying and correcting one single, recurring behavioral flaw, a discovery made possible only through the disciplined practice of journaling. Your journal is the machine you build to turn your expensive mistakes into priceless assets, transforming the chaotic noise of the market into a clear, actionable signal for self-improvement and ultimately for the creation of lasting wealth. You have just been given a powerful and profound tool. You have absorbed a complete framework for turning your inevitable investment mistakes from sources of shame and loss into the very foundation of your future success. You've learned how to escape the ego's prison, how to conduct a rigorous post-mortem like a professional, how to focus on process over the seductive noise of outcome, how to build an anti-fragile mind that profits from chaos, and how to forge it all into a system of continuous improvement with an investment journal. This is more than just a set of tips. It is a fundamental shift in mindset. You now possess the blueprint to stop repeating the errors that hold you back and to start building a process that is resilient, intelligent, and designed for the long haul. You have made an investment of your time to get here, and that investment has armed you with a mental model that can change your financial life forever. But it is crucial to understand that what you have just mastered is one powerful node in a much larger network of thinking. Warren Buffett's success is not the result of a single mental model, but a latticework of interconnected models that support and enhance one another. The ability to learn from your mistakes is incredibly powerful, but its true potential is only unlocked when it is combined with superior models for making the initial decisions in the first place. How do you analyze a business? How do you assess the quality of a management team? How do you determine the intrinsic value of an asset and demand a margin of safety? The system you've just learned helps you correct your course, but what about the models that help you set the right course from the very beginning? The video that is now appearing on your screen is not an accident. It has been selected because it represents the next piece of the map. It is the crucial link between the framework you have just acquired for learning from the past and the framework you need for building a more profitable future. Think of it as the other side of the coin. You have mastered the art of the post-mortem. That video holds the key to the pre-mortem, the art of making fewer, better decisions from the outset. It is the link that connects everything. The choice before you is simple. You can stop here, with one powerful tool in your arsenal, or you can continue the journey. The click you are about to make is not just about watching another video. It is a decision about your own identity. It is a commitment to moving from a person who merely invests to a person who is building a complete, world-class mental arsenal. It is the next step in your ascent. Complete your toolkit, sharpen your mind. The path forward is right there. Click and continue.